In Forex trading, diversification is the closest thing to the holy grail that you will ever find. Not only does it help you get higher returns, you can also massively reduce your drawdown as opposed to just adding more leverage. And the greatest thing about Forex Expert Advisor or Forex robot trading is you can trade a whole basket of strategies simultaneously with essentially no additional effort over just trading one or two because you're able to automate all of your trading. So today in this video, I want to actually walk you guys through some concrete examples of what diversification actually does to your equity curve. Because people say, yes, you should diversify all the time, but I want to concretely show you the math behind it so you can really see how this will impact your trading performance. And it's really pretty amazing once you actually see the impact. So stick around to the end so you can actually see how this can revolutionize your trading going forward. So for this example, I want to use our prop firm bundle opening range breakout portfolio. So this is a bundle of 3 different expert advisors, one of which trades the opening range breakout on the DAX. So that's our German Lightning expert advisor. We're also going to be looking at our US Lightning expert advisor, which trades the opening range breakout on the US 30 or the Dow Jones. And finally, we're going to look at our very famous free expert advisor, the Golden Time Bomb, which trades the opening range breakout and the London breakout on gold. And when I say opening range breakout for the DAX or for the US 30, please note that I'm always corresponding to that particular market's opening time. So the DAX is not trading the New York opening range breakout, it's trading the Frankfurt opening range breakout, whereas the US 30 would obviously be trading more the New York market open. And here you guys can see we have 3 different equity curves, and these back tests were ran from 2022 until just a couple of weeks ago before daylight savings time to keep it easy with the time zones. And here you can see that the equity curves are not like having that exponential growth because I turned off compounding. So for all of these back tests, I'm using fixed volumes just because if you use a percentage of balance, what will happen is towards the end, the trades here are going to be way larger than the trades at the beginning because you're continuously reinvesting your balance. And particularly if you're trying to run a portfolio and you're trying to see the impact of more portfolio balancing and diversification, it's not a good idea to do this because you're going to overweight whichever strategy does best towards the end. So that kind of introduces a look-ahead bias, so don't do that. Essentially, that's way too detailed to go into the weeds regarding what all of that means. But effectively, for these back tests, they're all using fixed volumes. So if you were to actually reinvest, if you were to use percentage risk, the results are going to be actually quite a bit better. So here to walk you guys through the strategies, we are risking around 1% or roughly 1% per trade on Golden Time Bomb, and risking 1% here, we're turning $1,000 into $2,700-ish from 2022 to today with around a 10% drawdown. And this is the free expert advisor, by the way, so it's an excellent strategy and you can get it for free with the link in the description. And here now with our US Lightning Expert Advisor, we are risking around 2% here, and we are turning $1,000 into around $2,400 over the span of 2022 to today with around a 14.8% drawdown. One thing to note is US Lightning has actually been performing outstandingly well the past year and a bit, but it had a fairly flat 2023 due to some choppiness in the US equity markets. Therefore, the average return is not going to be as high as Time Bomb, but the recent returns, it's been the best performing expert advisor that we have. And now we can go to German Lightning. On German Lightning, we're trading the DAX, and here we're actually only risking 0.5% per trade because it's a high risk reward, lower win rate expert advisor. As you guys can see here, we're winning around 37 or 36% of the time, but we have a very positive risk reward. And that's why obviously if we lose more, but when we win big, we're going to risk less per trade. So in these 3 different back tests, I chose to use very conservative settings because I'm trying to show how we can combine them together. But to actually kind of go further into the details as well as show you the math behind diversification, I'm going to open the Strategy Quant Analyzer program. And this is an amazing tool which helps you combine back tests together and show you how the entire portfolio would do together. So here you can see with German Lightning, we are having around a 29% annual return with around a 7% or 6.6% drawdown. And then hopping over to US Lightning, we're having a 43% annual return with around a 14% drawdown. You can see the equity chart right here. And finally, we can go to our free Golden Time Bomb Expert Advisor with around a 52% annual return with a 9.95% drawdown. But now what I really want to show you guys, and pay attention to this part because it's really amazing, is if we combine the bots together, what happens? And if we build a portfolio, what happens, right? And essentially what I did is I took these 3 bots and they're all trading $1,000 themselves. And the best return we're seeing for all 3 is around 52% annually. And the actual drawdowns we're seeing, the worst drawdown is around 14% or 15%. What happens if I take all 3 of them and I run them together? What does that look like? And here we can hop over to our orb portfolio, and we can see that if I use the same amount of money, so I'm not trading 3x the capital, I'm only trading, let's say I have the same $1,000, I can run it with 1 bot or I can run it with 3 bots. What happens? Like obviously returns will be higher, but the thing that you should really put your attention to is the drawdown, because the returns are going to expand if you're making far more trades. But what happens to the equity drawdowns? Because one might assume that if I'm trading way more, do the drawdowns add together? Like, does it make the drawdowns worse? Do I need to add more capital? But the takeaway of this video is if you're running inversely correlated strategies, and as you can see, we're not inversely uncorrelated strategies, like as you can see, they have effectively no correlation. If you guys remember high school math, this corresponds to the R-squared values. If you run these bots together, not only do you have way higher returns of 125% annual returns, your drawdowns are way lower. So on the same capital, if you put them together, because when some bots are having losing periods, other ones are having winning periods, you have way lower drawdowns with way higher returns on the same amount of capital. Obviously, if you put way more bots in, you would have to increase your capital base. But just showing 3 bots which don't trade that often together gives us a really good illustration here. And if we look at the combined equity charts, you can see that we have these 3 different bots, which when we combine them together, it gives us this blue equity curve. And during some of perhaps, like let's say see this 2023 more choppy period for US Lightning, we're still making very good money. And in these recent years where the bots have been, these are the ideal parameters for recent years too, we can see like absolutely phenomenal performance. So this is pretty incredible, right? Like we're getting lower drawdowns and way higher returns. And really the big takeaway here is if we wanted to get similar returns just by increasing trade size in one particular bot, our average returns or our average drawdowns would be significantly higher. And maybe to end this video right now, we can walk through kind of the monthly performance of the orb portfolio. One thing to note is this number is a few weeks old. It's actually has been very good in March so far. But if you go through all of these different months, you can see that we're having consistent, really great returns through 2024, most of 2023, and most of 2022. And if you run longer back tests, you tend to run into data issues, but the same strategies, if you have sufficient data, also tend to be very good. And what this shows us is this approach is ideal for prop firms because you have consistency. And effectively, if you can put these bots together, you're able to have consistent month-over-month profits, which can help you generate sustainable payouts. At the same time, a really cool thing about these bots is you know exactly when they trade. Because they're all trading opening range breakouts, you are able to know how many times a day at most they are able to trade. And that enables you to really accurately control your risk. In this particular analyses, we were risking 2% on Lightning, 1% times 2 on Time Bomb because it trades twice a day, and 0.5% on German Lightning. That means in the worst case scenario, if every single trade lost, we would be down around 4.5% in the day. And this enables you to stay within your total max daily risk drawdown. And depending on your exact prop firm's parameters, you would then be able to perhaps allocate a bit less to a particular bot, or you'd be able to take a bot off or just reduce the risk, kind of broad basket on all the bots. But that's the idea here. Through the use of diversification, just mathematically, you massively improve your trading. And I don't think many people actually kind of get this until they actually run the combined back test themselves. and see what the impact can be. So just wanted to share this with you guys. Hope you found it interesting, and have yourselves a wonderful day.